You probably heard people say a stock is overbought or oversold, but what does that actually mean? And how do investors measure it? One of the most common tools used for this is something called an RSI score. RSI stands for Relative Strength Index. It's a technical indicator designed to measure momentum. In other words, how quickly and how aggressively a stock's price has moved over a recent period of time. RSI doesn't tell us whether a company is good or bad. It tells us whether price movement may be stretched in one direction. RSI is plotted on a scale from 0 to 100. Without getting too technical, it compares the size of recent gains to the size of recent losses over a short time frame, usually about 14 trading days. The result gives us a snapshot of buying versus selling pressure. Traditionally, an RSI above 70 suggests a stock may be overbought. An RSI below 30 suggests it may be oversold. But this is where many investors misunderstand RSI. Overbought doesn't mean sell immediately. Oversold doesn't mean buy right now. In strong bull markets, RSI can stay above 70 for extended periods, sometimes months, while prices continue to rise. In weaker or declining markets, RSI can stay oversold much longer than people expect. That's why professionals don't use RSI in isolation. They combine it with trend direction, support and resistance levels, and overall market conditions. RSI is about risk awareness, not prediction. When used properly, RSI helps investors avoid emotional decisions. It can signal when enthusiasm may be getting extreme or when pessimism may be overdone. That makes it especially useful for position sizing, entry timing, and risk management. So is RSI important? Yes, when it's used the right way. It helps investors understand momentum, risk, and probability instead of reacting to headlines or short-term price moves. If you want to understand how tools like RSI fit into a disciplined investment process, feel free to reach out.